The GM CFO, Paul Jacobson, joins us now for more. Paul, welcome to the program and congratulations on the result. It's a beat and a raise. I'm intrigued by the raise, Paul, so let's start there. What powered that raise this morning?
Sure. Well, good morning, Jonathan and team. Thanks so much for having us today. You know, we're here to celebrate in large part the accomplishments and achievements of the GM team across the board. And I think the theme for the day is consistency. You know, the team has really executed well over the last few years. Our go-to-market strategy, our inventory discipline, our incentives remain below the industry average across the board. The consumers remain resilient across the board as well. And we've seen some good tailwinds coming in the form of continued warranty improvement, our EV profitability journey, as well as pretty significant ramp in our digital revenues across the board. So when we look at that and measure it against even some of the macro headwinds that are out there, we felt confident raising our full year guidance by another $500 million, effectively taking our outperformance in the first year and banking it, and really continuing to drive those results. But incredibly proud of the team and what we've been able to accomplish.
I can see that this morning. Paul, also the pricing power. Let's just sit on that just for a beat. The pricing power is impressive. We see gasoline prices back to $4 a gallon for the first time in something like a month. That problem has persisted through Q2 into Q3. You've got great experience of dealing with energy prices in your time over at Delta. It's different in the same seat over at GM, but can you describe how this works? When you see gasoline prices push up the way they have, what is the relationship between that and sales for General Motors?
Well, certainly the airline industry has a lot more ups and downs than the auto industry does as it relates to oil prices. But, you know, what we look at is where is the health of the consumer? Where is the demand? And, you know, our full-size truck sales are up 4% year to date. We expect that to be flat for the year, mainly because of production, because we're cutting over to the next generation of trucks, which we're really excited about. It'll be the most capable pickup truck we've ever produced with a brand new Gen 6 V8 engine, as well as diesel options across the board. So, you know, the success that we've seen in the last year of a generation of trucks is really unprecedented, and we've held in on price and demand as well, and that's remained consistent. So as we look at the overall energy price environment, it hasn't really impacted us. We're still selling full-size SUVs as quickly as we can make them, but we have a much broader product portfolio. You know, we like to talk about here that, you know, when you look at our crossover portfolio, the profitability is up 4x from where it was just in 2020. So we've gotten much more efficient at a broader portfolio to be able to meet customers wherever they are.
Paul, there's a line in the statement this morning from Mary, and it reads as follows, just a short quote. We have multiple engines of margin expansion. Can we just sit on the margin expansion as well? I think this is really important. You know what we're like, Paul? We sit around this table every morning and we worry for 3 hours about a bunch of risks. You have to execute. We've spoken this morning about higher prices for chips, higher prices for energy, the prospect of increased tariffs. How do you make sure that you've got that cost discipline, to make sure you've got the flexibility as well, to see those margins and that margin performance continue, even with that price pressure coming from all directions?
Well, if you're pros at worrying, that might set you up to be a CFO someday. So keep at it, because we have to worry a lot, you know, in our desk as well. But, you know, we've really also got to focus on what is that playbook that we can do, can execute to overcome. And I think what the team has really done is we don't make excuses. We're out there trying to find productivity where we can, enhancements across the board. So when you look at what the team is doing with quality improvement, and, you know, we've increased our warranty savings year over year from $1 billion, which we came out at the beginning of the year, to $1 to $1.5 billion. Our digital revenue, which we're really excited about, will be over $3 billion this year, and we expect to add 1 million new subscribers to our digital channels. So the team is really executing, and I think that's what's really different. When you look at 10 years ago, we were producing about $3 to $5 billion a year in free cash flow. Today, we're producing over $10 billion a year in free cash flow, and it's driving that efficiency in spite of what everybody would argue is probably a more challenging macro environment than where we were a decade ago. So you know, we're really proud of these results, and we're continuing to execute and expect that the market is going to continue to see that.
Building on Jonathan's point, though, when it comes to TSMC this morning, they're looking at 10% higher prices next year for their chips. Do you at some point have to start passing chip costs specifically down to the consumer?
Well, we look at it in the entire equation. So coming into the year, we talked about $1 billion to $1.5 billion of inflationary pressures. We took that up after we saw the Iran conflict. Some of that is chip inflation as well. So our supply chain team is out there sourcing everything that we can. The first and most important thing is that we don't impact production, and we've been very, very consistent in that space. So while we are seeing some inflation, the opportunities and the tailwinds we have elsewhere in the business have been more than enough to overcome it. And that's why we've been able to get back into our 8 to 10% margin range in North America, despite $3 billion of tariff headwinds and other inflationary pressures as well. And, we think many of those opportunity sets that we have are going to carry us in with even more momentum into 2027 and beyond.
I'm glad you mentioned tariffs. I know you've done a lot to try to reduce the tariff bill, but are you having some PTSD this morning when you wake up and you see the president is talking about Canadian tariffs once again, which is key for your supply chain?
Well, there always seems to be something happening the day before earnings, but in this circumstance, this isn't anything that is impacting us. These new tariffs that were announced don't fall under Section 232, which is what covers autos. And and I think if we could encourage the parties, we would love to be able to get the deals done with Canada and Mexico. Mexico seems to be a little bit ahead of Canada right now, but I think a good trading bloc that meets all of the countries' needs is really important for us competitively. We've got a lot of capital that we've been putting in place, almost $6 billion into the United States to onshore production of both vehicles, full-size trucks, as well as the new Gen 6 engines that are coming in. We're increasing production across the board. We'll have over 2 million units produced in the United States when all this is said and done. So, I think we've been able to make adjustments, but, consistency is helpful, especially when you have a multi-year planning cycle.
Paul, I don't want to put words in your mouth, but is that a frustration for you and the team, for the executive team, for the whole team at GM? You just want to know the rules and you'll get on with it.
Well, I wouldn't classify it as frustration, Jonathan. I would just simply say, there's a lot of volatility in the world, and if it wasn't tariffs, it might be energy prices, it might be global conflict or geopolitical issues. And that's why I say as a team, we don't sit around and make excuses. We look and try to figure out what is that playbook that we're going to execute, where are we going to continue to try to find the opportunities to expand margin. And what the team has done is pretty remarkable. And it's now 3 years straight that we've delivered these types of results. And feel very, very optimistic about our ability to weather the storms wherever they might come from.
Well, it's a beat in a race this morning. It's impressive. Paul, we appreciate your time. You're always generous with it. Thank you. Paul Jacobson there, the GM CFO, following a beat in a raise and a raise of $500 million for the profit forecast this morning.